Climate risk and its impact on the investment management industry and risk management. Introduction. Climate risk refers to the potential adverse impacts of climate change on various aspects of the global economy, including the investment management industry. As the world grapples with the challenges posed by climate change, it has become increasingly important for investment managers to recognize and address these risks. This document explores the impact of climate risk on the investment management industry and the significance of effective risk management strategies. Climate risk and the investment management industry. A. Physical risks. Climate change leads to an increase in physical risks, such as extreme weather events, rising sea levels, and changes in temperature patterns. These risks can have a direct impact on investment portfolios, especially those exposed to sectors vulnerable to climate-related disruptions, such as agriculture, real estate, and infrastructure. The investment management industry must consider the potential financial implications of physical risks when assessing investment opportunities and portfolio diversification. B. Transition risks. The transition to a low-carbon economy introduces a new set of risks for the investment management industry. Transition risks arise from policy changes, technological advancements, and market shifts associated with the decarbonization efforts. Examples include regulatory changes, carbon pricing, changes in consumer preferences, and advancements in renewable energy technologies. Investment managers need to evaluate the potential impact of these risks on their portfolios and adapt their strategies accordingly. Impact on risk management. A. Portfolio performance. Climate risk can significantly impact the performance of investment portfolios. Failure to account for climate-related risks may lead to financial losses and underperformance. Incorporating climate risk analysis into risk management frameworks can help identify potential vulnerabilities and enable proactive adjustments to mitigate risks. This approach ensures that investment managers are well positioned to capture opportunities arising from the transition to a low-carbon economy. B. Investor expectations. Investors are increasingly prioritizing environmental, social, and governance (ESG) factors, including climate risk, when making investment decisions. Failure to address climate risks may lead to reputational damage and loss of investor confidence. Investment managers must demonstrate a robust understanding of climate risk and implement strategies that align with investor expectations for sustainable and responsible investing. Circa regulatory landscape. Regulators worldwide are recognizing the importance of climate risk and are implementing frameworks to promote climate risk assessment and disclosure. Investment managers need to stay abreast of regulatory developments and ensure compliance with emerging climate-related reporting requirements. By adopting proactive risk management practices, investment managers can navigate the evolving regulatory landscape and maintain regulatory compliance. Effective risk management strategies. A. Climate risk assessment. Investment managers should conduct comprehensive climate risk assessments to identify and evaluate climate-related risks across portfolios. This assessment should consider both physical and transition risks, as well as sector-specific vulnerabilities. Integration of climate risk analysis with traditional risk assessment models enables a holistic understanding of portfolio risk profiles. B. Scenario analysis and stress testing. Scenario analysis and stress testing are valuable tools for assessing the potential impact of different climate scenarios on investment portfolios. By simulating various climate-related events and their financial consequences, investment managers can identify portfolio vulnerabilities and develop appropriate risk mitigation strategies. Circa engagement and collaboration. Investment managers should engage with companies, regulators, and stakeholders to encourage climate risk awareness and management. Collaboration with industry peers, data providers, and research institutions can enhance the quality and availability of climate-related data, leading to more accurate risk assessments and informed investment decisions. Conclusion. Climate risk poses significant challenges to the investment management industry. Investment managers must proactively incorporate climate risk analysis into their risk management strategies to protect investor capital and capture sustainable investment opportunities. By recognizing the financial implications of climate change, implementing effective risk management practices, and engaging with stakeholders, Investment managers can navigate the evolving landscape and contribute to a resilient and sustainable future.